In due course, whatever then takes place that sees gold sell off, churn, not really make any more highs, what other form of progress, decay, or pullback or sideways action it does take. In the long run, we continue to see it making ever higher values after that time period. Remember, there are technical views for certain time periods. Right now, on the short time frame, we remain bullish till the target is run of making that 2,900. It is not my expectation that they, whoever that may be, will allow a 3,000 run so soon after a 2,000 clear-cut break.
Gold has shown impressive technical strength recently, and it's exciting to see where it might be headed. Analyst Francis, the market sniper Hunt, has pinpointed a solid support level at $2,690, supported by a bullish hammer pattern and reassuringly low volatility. Just recently, gold reached a 2-month high of $2,750, mainly due to increased demand as a haven in response to the tariff threats from Trump regarding China. The $2,730 mark, established by a reversal head and shoulders pattern, now presents an essential resistance point, especially since gold had previously tested the $2,542 level amidst a stronger dollar. Looking ahead, technical analysis reveals a potential breakout from a symmetrical triangle at $2,785, with thrilling possibilities of new record highs. Hunt's insightful analysis of the HVF pattern, viewed through a 6 to 8 hour time frame, suggests a target of $2,893. This pattern was triggered on January 8th and achieved its first interim move by January 22nd, showcasing predictable low-volatility breakouts and steady support even during pullbacks. However, it's essential to consider several factors that could prompt a short-term retracement in gold prices. These include rising bond yields, an appreciating dollar, shifting sentiment towards equities, gains in cryptocurrencies, and diminished geopolitical risks. Gold, being dollar-denominated and reliant on mining for supply, tends to react sensitively to dollar fluctuations, typically moving inversely. The long-term outlook for gold is optimistic and aligned with UBS's projections, which echo Hunt's analysis. The financial institution forecasts that gold could hit $2,900 per ounce by the end of 2025, even while we may see some near-term sell-offs or sideways trading. This reinforces the view that gold will maintain its upward trajectory, with Hunt remaining firmly bullish until we reach that $2,900 target. Before we proceed with our discussion, we'd love for you to subscribe to our channel and hit that bell icon so you don't miss any updates. Also, feel free to share this video with your friends or anyone who might find it useful.
What are we talking about? A confluence of targets are when many patterns, or two minimum, actually are giving a similar level across different time frames and potentially different pattern types. So the original call of 2,893, the doorstep of 2,900, likely to lead to a technical run of 2,900 and thereafter a rest, which has say that the 1,000 number, the round numbers of 1,000, you'll remember an upside HVF, we'll take you to that chart in a minute on the bigger time frames just now, that sat on top of the 2,000 after the once, twice, 3 times, then your lady on the break that took out the 2,000, that the next move would take you to the doorstep of 3,000. We'll show you that pattern and that jaw in a minute. What's interesting now is we are getting a winding up HVF structure. Our community may be substantially long gold. I am on this particular setup pattern. That is a 6-hour pattern. It could be stretched to an 8-hour maybe. And this is giving us a target of 2,880. 2,889, in fact, my apologies. Let's get the number from here. 2,893. We'll get it eventually. There we go. Read your own box. 2,893 on this upside HVF. That triggered in and around the 2.6 levels around the 8th of Jan. We have now the 22nd of Jan. You've got a first interim make. This is what I love about HVF method that people should learn to appreciate and value, is that you stay the course because the things that happen are expected to happen when they happen, and typically are very, very compliant. You could see quite a low vol walkout break that happened there. You did number 1 stage, the break and feign back in stage. Then you ran first interim, which is that little dotted line. We make it more faint because it's not the most important target. It's the first step. Then you get what's called the return move to funnel stage, after acknowledging and making the first interim. This is very typical of HVF setups. We're going through the 5 stages to a breakout. You'll learn about that when you do our theory. Click the link below to book a call or a course. Then you move firmly away from the funnel. Often what happens is the first interim then serves as support. So you had a downside revisit here before turning and closing up there and then making a high there. You've had some degree of a pullback and you've had a hammer with the base of the hammer there. So there's two respects of the first interim as a minor key level of significance, 2690. It gives you the number, it's the gateway of 27. You pull back, you just sit technically on the 27s. Remember, round numbers are pegging, but isn't that interesting how the first my first interim level target serves as support twice. Low volatility points to very low volatility after a strong hammer, which defended on the first interim, points to the likelihood of further upside. Upside comes, you run another key level, 2,730. Where did that key level come from? The reversal head and shoulders. That occurred up top here, that nobody really saw or talked about except us, I imagine, in the community again, where you had a final test of the 2,730 armpit 1, and you had the first test after the high, which is armpit 2 over there. You broke down, you made this target on the downside with a little bit of overrun as is typical. You can see a hammer in there and you got your reaction where you would have given back more than 60% of your short if you had taken a short. I don't short gold in this current environment on any time frame. And then further downside capitulation. There was a lot of dollar dominance during this period, and the gold sold off right the way down to 2,542. Some people got panicky.
As we continue, Hunt anticipates that gold may reach a localized high, leading to a period of stagnation similar to past market cycles. During these times, investors might want to explore other markets like energy or cryptocurrencies, as gold could face some resistance before making its next significant moves. This aligns with gold's established reputation as a store of value, helping preserve purchasing power during inflationary times or amid evolving central bank strategies. Its limited supply distinguishes it from fiat currencies, enhancing its intrinsic value. That said, Hunt does highlight that market conditions in March 2025 may pose challenges to risk assets, including gold. He offers a thoughtful suggestion to set time limits for investment targets, recommending profit-taking if momentum wanes before arriving at those goals. Experts speculate that gold might range between $2,990 and $3,040 per ounce by March 2025, while silver is projected to open at $32.06 and fluctuate between $28.68 and $32.06. These estimates indicate that while gold's long-term value remains robust, short-term volatility could impact its immediate price movement. Now let's shift back to the interview.
And what I suspect will happen is that you're about to have a little bit of a localized high. Even gold turned here and you ended up sitting for 6 months before you meaningfully went significantly higher. In fact, it was more than that. I'm thinking of the Bitcoin. That was August 20, right the way through to 24. You sat for the better part of 3.75 years, 3.5 years, going largely sideways and failing to be significantly higher. And 99% of the time you were lower until this event. Don't tell me that doesn't matter to your performance, the time and concentration you give to a market. You can go away and focus somewhere else. Focus on the energies, focus on the cryptos, focus on the indices. There will be other setups that will be doing stuff. It was not the 3.5 years you wanted to be focusing on gold. It was chop and churn. Of course, small time frame traders might have found a little bit to do. Most of them don't make money in the long term. Real considered moves that take you away from the level, either to the downside or the upside, are generally where most people make their most money. In short, breakout trading, new level takeouts, this is where the money is made. Range traders, most people lose in a range trading environment. And all the stories you hear of selling and buying back and selling and buying back in a range, the only people who are typically successful often are in banks, and are liquidity providers themselves and very dominant players. Anyway, back to this. That is where the target comes from. It comes from the long-term low right down here at 1,155 right the way through to here. This is projected by a HVF method, by the way, and has always provided this target. And now we have a winding up. So this is probably on a weekly time frame. I've compressed the candles almost disorderly, so let's also just do that for you in a bigger time frame so that you can see it. I'll also take off our HVF draw box because it's making a bit of mess now on these bigger time frames. That is the move from there to there, which was the beginning of the last bull market, to the localized high for the better part of nearly 4 years. Do you want to know where the localized high for a while is? And what does it tell you that it's the localized high for an extended period? Now, I'm not saying it's going to be 4 years. These have consistently got shorter and shorter, and gold is in dominant theme for upside. So I think it is going to be significantly less. But even if it's 6 months, I don't want to be sitting trying to buy a selling off market. What could this mean? We also are expecting a dollar super surge on interest rate spiking in the dominant world currency as per its design. That part, Brent Johnson on his dollar milkshake theory has 100% got accurate for me. And as a result, but this is not something to be bragged about. It's a condition of failure. We're talking about failure of all debt markets, and specifically the US debt markets, which are going to lead to an interest rate driven dollar shortage and increase in rates, which are likely to benefit the dollar short term in what is considered to be a sugar stroke schizo strength rather than a healthy strength.
Gold continues to stand firm as a reliable store of value, especially in uncertain economic times or periods of inflation, thanks to its limited supply and vital worth. While we may encounter short-term fluctuations that could lead to stagnation periods, the overall trend for gold hints at growth, primarily due to its role as a hedge against monetary instability. Price forecasts suggest that gold's upward path could persist, with impressive levels on the horizon. As a hard asset, gold's unique ability to preserve purchasing power distinguishes it from other commodities and currencies, solidifying its lasting appeal for investors. What are your thoughts on gold's potential to maintain its upward trajectory despite short-term challenges? Or do you expect market volatility to affect its pricing significantly? I'd love to hear your insights in the comments below. If you enjoyed this analysis, please remember to like, subscribe, and hit the bell icon for further updates on gold and the ever-evolving market trends. Thank you for tuning in.